Hi students, in the last lesson we have seen how to do CVP analysis for single product. Now we are going to see multiple product CVP analysis. That means same company sells more than one product. How do we find the break-even point, break-even value, margin of safety, budgeted profit, all that we are going to see. So let me take an example. Example 1. A company makes and sells two products, alpha and beta. Alpha, beta, selling price 20, 30, variable cost per unit 8, 15, sales volume 2000, 1000 units. Right. So selling price will be given for each product separately, variable cost will be given for each product separately, sales volumes will be given for each product separately, but fixed cost will not be given for each product separately. Fixed cost will be common. For example, factory rental, factory manager's salary, head office expenses. This won't be there for each product separately. So you will have common fixed costs. Fixed costs. Let's say $25,000 per month. So if I want to find break-even point, I can't find for each product separately. If I want to find for alpha only, you remember our break-even point formula, single product break-even point formula. What was it? Fixed cost divided by contribution per unit. I can find contribution per unit of alpha, 20 minus 8 is 12. But what fixed cost can I use? 25,000 is not only for alpha. It's not only for beta. So understand, if there are multiple products, analyzing them individually, each product doesn't work. So how we approach this, we take an assumption. What is the assumption? Look at the sales here, sales or demand, 2000 alpha and 1000 beta. 2000 alpha and 1000 beta. If I simplify, if I leave these zeros, 2:1 is the ratio. Can you see? 2 alpha, 1 beta. So we are going to assume, look at the assumption. Alpha and beta will be sold at a ratio of 2:1 at a constant ratio of, let's say, at a constant ratio of 2:1. What does that mean? If you sell 2 units of alpha, 1 unit of beta will be sold. Alpha and beta will be sold at a constant ratio of 2:1. That means if you sell 2 units of alpha, 1 unit of beta will be sold. Imagine alpha is, let's assume this is a mobile phone seller. Alpha is Samsung mobile phones. Beta is Apple mobile phones. So according to these numbers, what it says is, if you sell 2 Samsung mobile phones, 1 Apple phone will be sold. 2:1. So today if you are selling altogether 30 mobile phones, 20 will be alpha, 10 will be beta. How do I say that? The 2:1 ratio will be maintained. That's the meaning of constant ratio. Every day, every hour your sales you make, 2:1 ratio can be observed. If that is so, we can find something known as weighted average contribution per unit. What is weighted average contribution per unit? You have alpha and beta. If you look at the contribution per unit of alpha, 20 minus 8 $12. Same calculation if you do for beta, 30 minus 15, that is $15. I want an average, not the simple average. You are not going to add and divide by 2 because the volumes are different. So the formula is this: weighted average contribution per unit. Formula is this, equals total contribution divided by total volume. What is the meaning of that? From all 3000 units, how much contribution you get? Find that. Divide that by 3000. You're going to get an answer. Average contribution from one unit. That is what you call weighted average contribution. So here, let me write volume. 2000, 1000. So weighted average contribution per unit, WAC/U. I need total contribution. How do I get total contribution? $12 into 2000 units plus $15 into 1000 units. That's the total contribution. 12 into 2000, 15 into 1000, divided by 2000 plus 1000. Total contribution divided by total volume. See how much we get? 13. Is it exactly 13? No. Yes, exactly 13. Then break-even point. You know single product break-even point, what's the formula? Fixed cost divided by contribution per unit. Same formula, slight difference. What is it? Fixed cost divided by weighted average contribution per unit. Earlier it was fixed cost divided by contribution per unit. Now it is fixed cost divided by weighted average, because there are multiple products, you need an average, weighted average. Substitute the numbers. Fixed cost 25,000. To get some whole numbers, it's okay. 25,000 divided by contribution per unit is 13. So you get 1,923 units as your break-even point. Altogether, you need to sell 1,923 units. Is it alpha or is it beta? It's both. It's both. Alpha and beta together, you need 1,923 units. So if somebody asks you how much of alpha and how much of beta does it include, if they ask only in the exam, if they ask how many units of alpha, how many units of beta, simple, take this units, split in this ratio. Look at the ratio, alpha 2, beta 1, 2:1 ratio. So 2 divided by 3. The other one will be this multiplied by 1 divided by 3. 2:1, right? 2 and 1. Just add up once again and see, are you getting this answer? 1,923, yes. So this is the break-even point. If the question MCQ asks you what is the break-even point, that's all the break-even point is. You simply have to find weighted average contribution per unit and then apply in the formula. That's it. If they go one step further and ask at break-even point how many alpha are sold, how many beta are sold, this is what you do. So we can do all the workings we did for the single product. We found contribution per unit. Similarly, we found CS ratio. Remember single product CS ratio? What was the formula? Contribution divided by sales. Same thing here. I'm going to say weighted average contribution to sales ratio, which will be total contribution divided by total sales. Simple as that. Total contribution. How do you get total contribution? All the products multiply and get it. This multiplied by this plus 15 per unit multiplied by 1000. Total contribution. You need total sales. How do you get that? Here 2000 units, $20 selling price plus 1000 units, $30 selling price. Weighted average CS ratio 55.71% weighted average CS ratio. Break even value You remember break-even value, we studied a formula. What's the formula? Fixed cost divided by CS ratio for single product. If it is multiple product, fixed cost divided by weighted average CS ratio. So everything is same. Everything is same. Single product. If I summarize the single product and multiple product formula, look at this. Single product, multi-product. Right. Break-even point. What's the formula? Fixed cost divided by contribution per unit. Multiple product, fixed cost divided by weighted average contribution per unit. Break-even value. What's the formula? Fixed cost divided by CS ratio, contribution to sales ratio. Here, fixed cost divided by weighted average CS ratio. What else we studied? Margin of safety. Same formula. If you want it in dollars, margin of safety revenue. What do we say here? Budgeted revenue minus break-even value. Same, no difference. Budgeted revenue, break-even value. Margin of safety percentage, same formula. Target profit, same formula. So everything is same formula. Only difference, if wherever you have used contribution per unit, now you use weighted average contribution per unit. Okay, come back here. So break-even value you will get fixed cost $25,000 divided by weighted average CS ratio, this $44,871. This is break-even value. Let's find margin of safety. To find margin of safety, I need budgeted revenue. Okay, we can find it. Margin of safety revenue. Maybe before that I will have one line for budgeted revenue. How do we get that? 2,000 units, $20 alpha. 1,000 units, $30 beta. That's the budgeted revenue. So margin of safety revenue means budget minus break-even value. Budget minus break-even value. Margin of safety percentage, how do you get? You should have revised a single product. How do we get it? Margin of safety revenue divided by budgeted revenue. Margin of safety revenue divided by budgeted revenue. That's 36%. That's margin of safety percentage. How do you find budgeted profit? Contribution minus fixed cost. So total contribution. How do you get total contribution? Here we have it, 2,000 multiplied by 12 plus 1,000 multiplied by 15. Total contribution. Some mistake. What did we do? Twice. Okay. Fixed cost how much? 25,000. Subtract it, you get the target profit. Not target profit, budgeted profit. Budgeted profit. Budgeted profit, how do we do? Based on the budgeted units, you find the total contribution. Then you subtract the fixed cost, you get budgeted profit. This minus this. Let me highlight each working separately. This is break-even value working. This is margin of safety percentage working. Then this one is about finding budgeted profit. Now let me ask you a question. What should be the revenue if the company wants to increase the profit by say 50%? So what is this? They have given you a target profit. They are giving you a target profit and asking you to find the revenue. Target profit. How much is the target profit? They want to increase. So they want this profit to be increased by 50%, means the new profit should be 150%. 50% increase means 150% target profit. When target profit is given, how do we find revenue? Revenue is, remember, fixed cost plus target profit divided by CS ratio. But multiple product, we don't use the CS ratio. What do we use? We use weighted average CS ratio. Target profit revenue, we already studied for single product, fixed cost plus profit, the whole thing divided by CS ratio. But if it is multiple product, fixed cost plus profit divided by weighted average CS ratio it has to be. So answer is going to be fixed cost 25,000, target profit you have it here 21,000 divided by weighted average CS ratio, we had it here. So if you are doing it in Excel, suppose if it is in section C, make sure you keep linking the cells. Wherever you want weighted average CS ratio, I don't go and type this 55.71. Did you see? I just link this cell. That's safe. This is the revenue to achieve the target profit. So all the calculations we did for single product can be done for multiple product. Only difference is this. What is it? We are finding a weighted average contribution per unit or weighted average CS ratio, and then we go ahead with the normal working. Okay. So revise these workings. Next we are going to see the graphs. After the graphs we will take some questions and see.